Hello and welcome to a brand new episode of Smart Money. Now on the show this week, we talked to Edelweiss about the launch of India's first passive short-term index fund. I know that's a mouthful, but this is an investment option suitable for any kind of debt investor wanting to invest for a minimum of 2 to 3 years with a low cost. Today we try and understand more about this investment asset class and how you can add it to your own portfolio. Radhika Gupta, the MD and CEO of Edelweiss Asset Management, joins in now to talk about that. Radhika, thanks so much for joining us on the show today. First, let's start off with the overarching theme, right? Passive funds. I want to try and understand a little bit about how one can add passive funds to their portfolio, especially at a challenging time like this when there's so much uncertainty globally.
So I think passive funds as a market and products options have really grown in the Indian context. And today, whether it's equity or debt, you have a very wide range of passive funds. And I truly believe passive funds, especially fixed income passive funds, can now become the core of your fixed income investing. Between target maturity funds, which we've talked about and can touch upon, and newly launched other kind of debt funds like this, all your goals can now be filled by passive funds with a lot of transparency as well as low cost in the fixed income format, and your entire core portfolio actually can now be built with passively managed funds.
Okay, so what you spoke about target maturity funds, debt index funds, the different kind of passive funds, but tell us a little more about passive debt funds and what investors can gain by investing in this asset class.
Many investors know passive equity funds. Passive debt funds are newer, but like passive equity funds, they are funds that follow an index. So the index typically tells you what kind of securities the passive fund could hold, typically the credit quality. So are they holding Government of India securities? Are they holding state development loans? Are they holding AAA PSU? Are they holding AA? Whatever that is. They tell you the tenure of the instrument. That's what the index tells you. And the passive fund's job, once there is an index, is just to replicate the index. The fund manager doesn't take calls. There are rules, and the passive fund replicates the rules. These funds are open-ended, and they tend to be also very low cost, as I said, compared to actively managed mutual funds. The largest category of passively managed mutual funds today is the category of target maturity funds. I want to say they're like open-ended FMPs or mutual fund format FPs. They're basically funds that buy and hold bonds that mature in a certain year. It could be 25, it could be 27, it could be 37, whatever it is.
Okay, I want to talk a little more, Radhika, about the target maturity debt funds. But before that, as an investor, what are the things that you need to look at before investing in passive debt funds?
I think the same things that you need to look at in active funds, except for the fund manager risk. So you need to understand what the passive debt fund is buying, so in fixed income, what are you really interested in? How long are you investing? So you want to know the tenure of the investment. What is the quality of your investment? And that quality is determined by the underlying securities. Now, the securities typically that passive debt funds hold are Government of India securities, state development loans, which are sovereign and as good as that, or AAA PSUs like Bharat Bond, which is a very well-known fund, holds AAA public sector companies or AAA corporates. So those are the two main questions. How long are you investing for? What is the tenure and what is the underlying?
Okay, how long, what's the tenure, and what is the underlying, right? So there is a lot of transparency as well. There's no lock-in period, so that works for these funds too. But this passive debt category, globally the AUM is massive. Can you help us with some numbers? Globally, what are the numbers looking like, and what's the trend that you're expecting in the Indian market in this passive debt category?
So globally, interestingly, passive debt funds are the largest growing fixed income category, and they're the largest growing passive debt category. And I've been a real believer of this for the last 3 years that, in passive, in fixed income, passive really brings a lot to the table. So passive today is a 50 lakh crore category globally. It's 12% of the fixed income category. In fact, in markets like US and Canada, as I said, it's one of the fastest growing categories out there. And passive solves the need of debt investors. Debt investors are very sensitive to cost, Sonia, because in equity, at least you have upside that can compensate cost, but in debt, you don't have that. Transparency, which you alluded to, is extremely important for fixed income investors, and we've seen the need for that over the last few years. Liquidity is something passive funds meet. So that's why I think they've been very popular globally, and globally, there's been a lot of innovation in passive fund structures. As far as India, the target maturity category is already 1.4 lakh crore in India in the last 3 years. That makes it the largest fixed income category after liquid funds, which is actually incredible. And it's been a period where actively managed fixed income funds have degrown in size. They've lost about 1.5 lakh crores. So the growth in passives has been breathtaking in the fixed income space over the last 3 years because they really meet a consumer need.
And they tick all the right boxes, right? Whether it's lower tax, more predictability in terms of what the upside could be, transparency, there's no lock-in period, more credibility, I guess. So at a time when there's so much uncertainty with equities as an asset class, perhaps a lot of people are resorting to other asset classes, like you said, passive debt funds. But what are the different schemes that are available to invest in within passive debt?
So I break the category into two. I would break it into target maturity funds and non-target maturity funds. Target maturity funds are the big part of the category because they're 3 years old. As I said, this is basically when you invest in a target maturity fund, there's a date by which the fund matures. It could be 25, it could be 27, it could be 2037. In a passive target maturity fund like 2025, the fund manager basically buys and holds bonds that mature in 2025, and then you do nothing else. You sit there passively. The advantage of this is what you said, predictability of return. So if I'm an investor who's buying a 2030 product and I'm holding for 7 years, I know that if I buy and hold my bonds, regardless of what happens to RBI rate, so many different macro variables, the yield that I saw at the time of investment is likely what I will get at the time of maturity. That predictability of return and that credit quality, that it's really good quality securities, AAA PSU has been very powerful for investors. Bharat Bond, of course, was the first target maturity fund, after which the market is really expanded. The second category is a new category, which is more constant maturity passive funds. Target maturity funds have a target date. They end on a certain date. Constant maturity funds are perpetual. So they typically have a tenure. It could be 1 year funds, it could be 2 year, it could be 3 years, but they don't mature. They're there forever.
So this target maturity funds, as you said, I mean, you guys do a lot of innovative stuff, right? So there was first the Bharat Bond, and now there's short duration index funds as well that you've come out with. Tell us a little bit about that. What is the advantage of putting my money in short duration index funds?
So after Bharat Bond and our own target maturity index funds, we received a lot of feedback from customers that while target maturity funds are great, they're great for people who want to invest for the long term. And they're also great for people who know how long they want to invest for. But for a lot of us, there's just money that we have lying out there that could be 2 year money, could be 3 year money. We don't know how long we want to park it for. So the target maturity construct doesn't work. And it's also kind of shorter term money. So, every year or 2 years, you don't want to be worried about rolling it over. You want the 3 year tax advantage that mutual funds have. So can you find us a solution? And what they said is, we like the fact that your passive portfolios are so transparent. So bridge this. And that's why this short duration index fund came up. I'm sorry it has such a long name, but it's meant to be very simple. It's meant to be a basic place where you can just park short-term money and let it be. It has a maturity of about 2.5 years on average. So if you have 2 to 3 year money, you just let it sit there.
Okay, well, on that note, let's take a quick commercial break on Smart Money, but don't go anywhere. We'll come back to talk about passive debt funds and how you can add it to your portfolio in just a bit.